Good morning, everyone. Thank you for joining another episode of the YVR REMO show. We're excited to have Chris Hoeppner of Home Equity Bank on the show this morning. We're going to be doing a deep dive into reverse mortgages, myths, common uses. This is a really hot topic right now, just given the environment that we're working through, how a reverse mortgage can be looked at from an investment component as a tool that we can dig into as well.
What's up, guys? You are listening to the YVR REMO show, where we talk all things Vancouver real estate and mortgages, take boring topics and make them interesting. Make sure to stay tuned to listen to everything you need to know how to put cash back in your pocket, create wealth in real estate, and simplify the complicated.
Chris, thanks for joining us. We appreciate it. Maybe just to start off, you could give us a little bit of background on yourself and your experience in the industry.
Yeah, my pleasure. Thanks for having me on the show. So I've been in the industry for about 22 years now, but focused specifically on reverse mortgages in the last 10 and a half years. So I work in the Fraser Valley area of BC here, and I've been able to sort of witness the growth of this product and the demand for this product over the last 10 and a half years. And it's been pretty exciting, actually. We watched 2021, we did about $1 billion in reverse mortgages, and last year we just did $1.38 billion. So it's the growth curve is pretty steep and up to the right.
Wow, that's incredible. To see that kind of growth, clearly there's many use cases for this product, and I'm looking forward to getting into those. But just for our listeners that maybe don't know what a reverse mortgage is, there's a lot of myths out there and misconceptions about what a reverse mortgage actually is. Maybe you can just kind of give us the breakdown of how you would sell it or explain it to somebody that has no idea what it is.
Yeah, absolutely. That's a good place to start, because a lot of people, you say the words reverse mortgage and either they don't know anything about them or they have some kind of preconceived notion about how they work. And unfortunately, a lot of that is really old information generated from other countries where reverse mortgages weren't regulated like they are here in Canada. We've been doing this since 1986. But we became a bank in 2009. So we're a federally regulated bank governed by OSFI. So there's a lot of consumer protection. And the program has really evolved and changed to meet the needs of our aging population in Canada. So a lot of the horror stories that people have from reverse mortgages, many of them are very outdated and based on programs that are very different from what we're offering here in Canada. The product itself really is not that complicated. People think you take your home and you have nothing left in your home and all these different things, but the reality is it's just a mortgage where you don't have to make payments. But there's a lot of flexibility with it. Essentially, we approve people for a credit limit against their home. They can take it all out at once, or they can take it, bit by bit over time. But it's a way to access some of that tax-free money they've stored up in their homes. Because what we're seeing in Canada is we have a lot of the older generation who have owned real estate for many years, and it's been a fantastic investment for them. And they're sitting on hundreds of thousands or millions of dollars of equity, of life savings. But it's very difficult for them to get at that money these days. So we're not saying reverse mortgages for everybody, but for that 55 plus generation, it's another option for them to get at the equity. And there's a lot of different uses that we can talk about, through this podcast.
Yeah, I mean, one thing that comes to mind for me, number one, someone that's a little bit older, probably retired, most likely. You're working and living off of a relatively low income for the most part. So even if you didn't have any mortgage at all on your property, but you wanted to access it, it's typically going to be quite challenging to get financing from an institution because of the qualification component, just because you don't have the income, right? I mean, right now we're stress testing all mortgages at close to 8%, right? So qualification in general has decreased by about 20% across the board over the last 12 months. So this is another product just to kind of assist with that lack of qualification for that niche kind of consumer. Right. And I mean, we touch on the income levels, and, there was a report that came out from an economist about a week and a half ago. And there was reference in there of the job numbers, which the job reports actually look strong for now. I'm sure that will be changing as time goes on. That said, we've actually seen a lot of job numbers increasing for people that are 55 plus. So that tells me, again, just talking about our current environment, life's expensive, right? Sure, if somebody has a mortgage, your payments have gone up. There's other costs, obviously gas, food, everything else that's increased. So a lot of people that are living on these pensions have gotten to a point where they actually can't even afford to maintain their lifestyle. So they're having to go back to work, right? Which is the last thing that anyone wants to do, which is, again, another reason where this product could come in and kind of save someone from having to do that.
Yeah, you touch on a few great points there. I get asked that all the time, well, why wouldn't I just take a line of credit on my home? And, for some people, a line of credit is a great product, but like you mentioned, stress testing, qualifying for that, especially once you've stopped working and you're on more of a fixed income, it's really challenging to get much of a line of credit or to get one that's going to be useful for you. And then, making a payment at a 3% rate was one thing. Making a payment at a 6.95% interest rate is another thing. So we're seeing a lot of people who actually have existing lines of credits on their home, and that payment has increased so much throughout this last year that, they're having troubles even making that payment month by month.
Yeah, these are great points. And one thing that comes to mind when you say 55 plus, like we're definitely getting into that baby boomer generation. Would you say like the majority of your clients are going to fall in that bucket?
Yeah, I'd say our like prime age is actually about 72. Because what we're seeing, what Derek mentioned about people returning to work, I'm seeing a few different scenarios. So one is we actually in 2021 there was a 30% increase in people in early retirement. So COVID brought a lot of perspective to people. Life is valuable, my time is valuable, quality of life, and so we actually saw a lot of people leave the workforce. But what does that look like from a cash flow perspective? The financial plan they had that expected them to work till 65, how does that change, right? So do they have the income they need to be able to afford that? So we saw a lot of that happen. Then we see people that are just carrying debt into retirement now because the real estate market's been so good for so many years that a lot of people kept refinancing and pulling money out of their homes, but now they're not mortgage free at 65 anymore. About 35% of people actually over 60 still have mortgages on their homes. And so how does that impact their ability to retire or their cash flow and their quality of life in retirement? And then as Derek alluded to, we're seeing people who maybe did retire, but inflation is eating up so much of their money now, into high interest rates eating up a lot of it. And they're having to return to work. They're having to find ways to supplement their income.
Yeah, and on top of that, investments haven't been doing very well over the course of the last 12 months. So if people have been relying on their investments to live off, that's been another hit. And another thing, I think just in general, it's always the goal to have your house paid off, right? Like that's always a big goal for people. And we're starting to see as there's more education out there around real estate and leverage that having debt is not necessarily a bad thing. People always want to have legacy and cash that they can hand down to their kids. But like a reverse mortgage product, if it's going to allow you to maintain a certain style of life and maybe, further invest, maybe get 2 or 3 properties that are going to be handed down to your kids, it doesn't always have to be the goal to have your house paid off when you pass away, right? There's other ways of looking at that model. And I just think that's a little bit of probably a baby boomer type mindset is the goal is always to have it paid off. But if you're not going to have it paid off, you have to look into products like this because it can absolutely change your life.
Yeah, it's a little bit of a change in mindset because everybody looks at their home as their home. They don't really think of it so much of it as an investment. But for 50% of people over 60 in Canada, they have an average of less than $200,000 actually saved up in RRSPs. And in today's day and age, that's not really a lot of money. It doesn't last them very long. And it's not always wise to pull money out of that RRSP because of the tax implications. And it can maybe affect some pension clawbacks and that sort of thing. But yeah, when you look at the equity in the home, your home's an investment. It's something you put money into every month with a mortgage payment, right? You paid and paid and paid for 25 years, and now you have $1 million sitting in that bank account. Leaving it there and not touching it is great for the next generation, but it doesn't do a lot to help you along the way. And I always equate it to somebody who, let's say they didn't have a home, maybe they put money into an RRSP their whole life, and they had $1 million sitting in RRSP today. More than likely, at some point, they would start using that RRSP and drawing it down. And in the end, even if you went through half of it, you're not leaving a debt to your estate. You're still leaving them $500,000. And a reverse mortgage is very similar in that it allows them to get at that big bank account in their house.
Yeah, that's such a great example, actually. And one of the things I wanted to touch on before we get into like the use cases and why you're seeing people, the main purpose for taking a reverse mortgage. One of the things I wanted to talk about was, again, going back to the baby boomer generation, I find it's they're very, how do I say this, conservative and protective of really everything they do. And I find, there's always taking the negative approach in some ways. And I'm just thinking of my own parents and my own family in this matter. It's like, to bring the concept of a reverse mortgage or anything that puts them into debt or changes their life. And it's a lot of reasons why these people live in the same home for so long. It's like they don't like change and they don't really trust anyone. It's hard to get their trust, and to bring this concept up to them can be challenging. And so I just wanted to ask you, like, what are some of the ways you get around that negativity when dealing with a customer that's very skeptical of the product? And then the next layer of that is, I'm sure you get parents, kids coming into the conversation as well, and then also wanting, you to explain why you're trying to put their parents into this type of a product.
It's a little bit easier for me to speak to because my own mom and dad actually have one, and it was a great fit for them. But that doesn't mean it's a great fit for everybody. I'm a big believer in knowledge. There's a lot of mortgage options out there these days. This is one of them. But too many people make a decision before they've actually gathered all the facts to see what it's all about, exactly how it works, and what it can do for them. I oftentimes encourage the family to come to the meeting so everybody can sit down and learn and ask questions, because in the end, it's the best interest of the clients that we're looking at here. And for some people, they're happy to live on little. They've done all the things in their life and they're fine. And the most important thing to them is to leave the biggest legacy they can to their kids. And that's great. For others, they've done lots. They've put kids through school and educations and helped them with down payments. And now they're at a point in life where, we're living longer. Life is costing more than ever before, and they need to look out for themselves. And there's all sorts of different reasons for that. But, in the end, it's really about education, because the product isn't as scary as people think. I think the first thing that comes to mind is, you've got this credit limit against your home, and you can use it for whatever you need it for, right? You can pay debts, you can draw cash flow, you can pull it out and buy an investment property, all these different things we'll talk about. But you don't have to make any payments. And so that for a lot of people, they think, okay, I'm not making payments. Interest is adding up and adding up over time. What does that look like? That scares me a little bit. Am I going to have money left at the end of the day? And I answer that, two ways. One is, we're a pretty conservative lender. The most we'll give somebody is 55% of the value of their home. But it's very important to know that that's based on your age. So in our world, we start at 55 as the youngest person, but that's also where we lend the lowest amount of money. You'll only get up to 55% of the value when you're probably over 80 years old. So we're quite conservative in how much we actually lend people. And so, there's a lot of buffer still left in that home. And so even though, that loan is increasing over time, it would take an extremely long time to actually eat up all the equity. But the other thing that people tend to forget is that their home isn't going to stay worth what it's worth today. Real estate's got its ups and downs over time, but in places, especially like Greater Vancouver, real estate goes up. And it doesn't have to go up a lot. In most cases, if you have $1 million home going up at 2% a year, and you have a $300,000 mortgage going up at, say, 7% a year, it's offsetting. That appreciation in the home over time is going to make up for the interest on the chip. And so once people kind of see the illustrations and they see the numbers on paper, they realize, wow, this isn't actually as scary as I thought. It allowed me to stay in my home, get at some of that tax-free money in the home, and all that appreciation in the property over time actually made up for most of the interest, and there's still a lot left in the end.
Yeah, I think those are really good points. I think another cost consideration that ties into that is, maybe someone's in a detached home that they've been in for 30 years. They don't want to move. All their memories are there. Now, if they didn't get into a product like this, they're probably forced to downsize, right? Although they might not want to. And nowadays, if you look at $1 million home, real estate fees, mortgage penalties, legal fees, transfer tax on the next property, like you can easily rack up $60,000, $70,000 in closing costs just to make that push, right? So then just another kind of factor to work into the equation from a savings standpoint.
Yeah, and then there's the emotional component, right? A lot of people, they spent a lot of years in that house. They've got their neighbors, their kids close by, their doctor, their church, all these different things. And so uprooting and moving a way to cash in that money, it isn't ideal for a lot of those people. For some it is, but downsizing, especially in the Fraser Valley, isn't what it used to be either. You used to be able to go from Surrey or something out to Chilliwack and save a whole bunch of money, and now even Chilliwack is pretty expensive.
Awesome. Well, Chris, you put together some really good notes here. It looks like there's kind of 5 main uses of the product, which I know we've kind of high level touched on these, but why don't we run through those, just starting number 1. So just elimination of mortgage, line of credit, or active debt. And just to touch on debt quickly, just as we saw, some job numbers are increasing for the 55 plus crowd. I'm sure that debt is also increasing if you're not able to maintain your cost of living right now, right? I think credit card debt's at the highest it's been since 2018, which I think is obviously, it's kind of an obvious stat, but that will continue to increase, especially over the next 12 to 18 months while we deal with the current situation, right?
No, absolutely. And that's one of the misconceptions out there is a lot of people think to get a reverse mortgage, you have to own your own outright. own your home outright. And that's not the case, actually. One of the most common reasons we're doing this actually is for people to pay off that existing mortgage or line of credit or other debts and eliminate all those monthly payments. Because again, the plan was to be mortgage free at 65, but life happens along the way. There's, in the last few years, a lot of people have lost spouses. A lot of that older generation lost a spouse due to COVID, and their incomes were okay, when there was two sets of them. But when there's only one, it becomes a real challenge. People had lines of credits they could afford 10 months ago. They can't afford them anymore. The rates are too high. And so whatever we approve a client for, so let's just, use an example of $1 million home, and we maybe let's say they're in their 70s, they might get 40% or something. So a $400,000 approval on this $1 million home, if they still had a $200,000 mortgage, we'd pay off that $200,000 from our $400,000, but that eliminates that monthly mortgage payment, which frees up all that cash flow for them for living and other things. And then they still have that $200,000 of available credit that doesn't cost them anything. We're not charging them interest on it, but it's available. So they can tap into that bit by bit by bit for anything they need as long as they live there.
That's a huge help for somebody that maybe doesn't think they need all that money up front, but knowing that they can access it at a later date. That's a very powerful way to, really kind of manage how much interest is accumulating over the course of, your duration of carrying it. One of the big tools that I've seen this, that makes a lot of sense to me is the ability to draw that as an income. And maybe you can just share how that function works in that other, type of product you have, and then the title of that product.
Yeah, again, another example of sort of how flexibility has improved over time. A lot of people think you just have to take out this large lump sum of money and that's scary for them. But it can actually be set up in a way just to kind of meet your budget. And so what we do is we give them this credit limit against the property. How you take it is really up to you. So we're seeing a lot of people, like I mentioned earlier, who only have less than $200,000 stored up in their RSPs, and that's not providing them, the cash flow that they needed. Actually, 79% of people 55 plus right now do not feel that their OAS, CPP, and RSPs are going to be enough to support them throughout retirement. So they need to supplement their income in some way. And what better way than that massive bank account they've stored up in their house over the years? So you save and save and save and save. And at some point in time, it's time to start using those savings, right, to fund the rest of your life. And so in my example I used earlier, which is $1 million home, and maybe we approve them for $400,000, you can set it up so you take what you need to start with. Maybe they need $50,000 up front to pay a few bills and update the house a little bit. Well, that remaining $350,000, you can actually take it as a regular income stream that shows up in the account every month. So maybe they want $1,000 a month to come on, and that's going to show up in their account for the next 350 months, right? So that's an example of how you can do it. But you don't have any payments to make, A, and B, you're only being charged interest on that money as you take it.
I was just going to say, over the course of 10 years, if you were to draw $1,000 a month, which goes a long way if you're on a pension, that works out to $120,000 just of funds drawn out. Obviously, there's interest costs on top of that, but $120,000 over 10 years. If you're in a property in the Lower Mainland, it's very likely your property is appreciated by far more than $120,000 in 10 years, right? So that's all you got to. I think you have to kind of look at it big picture, and you have to factor in that appreciation component, because when you think about it like that, it's a no-brainer, right?
Yeah, it's one of those neat investments that as you spend it, the value of your investment doesn't change, right? If you have $1 million in RSPs and you start taking money out of there, your RSP continues to get smaller, your growth on the RSP continues to get smaller, and you're paying tax on it. You have $1 million house and you start taking some money out of it, that doesn't change the value of your $1 million home. And in fact, that home continues to appreciate over time and is tax-free money. So it's a pretty big difference.
It's so cool to kind of just look at this as a concept of like a bank account. That's essentially what it is. And like, to draw it and look at your home as a liquid asset is pretty cool. And I think that's what's a little bit difficult for some people to wrap their head around. But when you explain it like that, it's so crystal clear as to why, you would want to have a product like this and why it makes so much sense. So yeah, thanks for explaining it that way.
So here's another big one that we see so much because of where we live and price of properties where we live. It's very hard for first-time buyers to save up their down payment, right? Like even 5%. It's pretty significant, especially given, everything that we're dealing with right now. So we've seen the bank of mom and dad come in handy significantly, especially over the last 12 to 18 months. We've seen more and more gifts being passed down from families. Sometimes it means parents are leveraging their property. Sometimes they're just handing down cash if they have access to it. But it's extremely common for these first-time buyers. And again, something that we've seen, a challenge that we run into, Parents on a pension, they want to pull out 100 grand or 200 grand to help their kids get that 20% down on their $1 million home because it makes sense financially, but they don't qualify to do it. Right. So just another great reason for this product. If you're not qualifying, and if you qualify for this program, a great way to tap into equity to be able to transfer that money down to family or whatever that might look like, parents or grandparents.
Yeah, it's the whole giving while living, and we're seeing a lot of it, right? As we're living longer and longer, some kid, if you wait till the parent or grandparent passes away, they might, if they're 90 years old, you're getting an inheritance when you're already retired yourself. And so there's a lot of people looking at ways of saying, look, you're going to get my house one day. Would you like to get some of it now? Would you like to get an advance on your inheritance, essentially, so that you can do things with it for all those years? And I, as the giver, get to enjoy giving that money to you and seeing what we can do with it. So it's, we see parents helping first-time home buyers. We see grandparents actually more helping first-time home buyers. We see parents helping middle-aged people that are looking to upsize. Their family's grown too big. They can't fit in that townhouse anymore, and they need to get into a detached home. But stress test rates being as high as they are, they need more down payment in a lot of cases. And I actually just had one recently out in Maple Ridge. The grandma was free and clear home, $2.5 million property, and all three of her grandkids were at a point where they were ready to buy. Dad didn't have the money to be able to help at that stage in his life. And grandma has equity. She doesn't have a ton of cash sitting around. So she actually did $1 million reverse mortgage. She took out 600 of it to start with, but she gave 200 and 200 to each of her three grandkids. And they were all able to purchase homes, get into the housing market. And those homes are all going to increase in value over all those years.
Such a smart way to do it. And like that early inheritance, I'm seeing that so much. And one area where I think this could be really, really impactful, and we talk about this a lot on our previous episodes around house hacking and how to get into, just your first property or investment property as a joint venture agreement where you're able to buy, the borrower is able to qualify for, say, a rental property, but they don't have the down payment. This is a way for anyone, not just a parent, to be able to contribute to an investment and be able to share in that wealth. And that's going into the next topic here is purchasing another home. So whether you're in a situation where you just want to invest with another borrower or whoever it is, you have that ability to now be able to get that down payment funds and put it into another property that's going to generate income. And one of the things I really wanted to talk about was just the idea of potentially in that scenario that you just mentioned, this lady's got $2.5 million free and clear home. What does it look like to maybe take out $300,000 and go buy a townhouse in the Edmonton area as a cash buyer, and then look at potentially $1,800 to $2,200 a month coming in from rent. These are strategies that would make a lot of sense. So even if your payment or not your payment, but the interest that's accruing on this reverse mortgage is at, say, 7.5%, you're buying a home that's potentially bringing in an 8.5% to 9% return from cash flow. That starts to make a lot of sense from an investment standpoint, but also now that person's living off that income. So, to go back to your supplement, your supplement income program that you were talking about earlier, to me, this would make more sense from a perspective of, hey, let's go buy a rental property that will just cash flow 100% and live off that income, and then and overall see quite some really decent growth.
Yeah, I mean, absolutely. Owning two properties is kind of everybody's goal, right? To time the market, right? If you're buying and selling in the same market, you're never going to really benefit from it. So this is a great buyer's market that we're in right now. And yeah, like you said, you can set this up on your house and draw income out that way. But if you pull it all out in a chunk and are able to buy an investment property, you're not only benefiting from the appreciation in the property over time, you're getting all that rental income that's coming in, because for a lot of the retired people, they can't qualify for a huge line of credit to purchase a rental property. And even if they could, all the rent is going to be going to pay the payment on that line of credit, right? So they're not actually benefiting from a cash flow perspective. So yeah, lots of different scenarios for that. One very common one is, I had one recently, $1.4 million home, I think, in Vancouver. They want to buy a place out in Chilliwack. And I think at the time they could actually get it for about $700,000. And so we'll give them as much as they can on their primary residence, but a lot of people don't know we can also lend on the place they're buying. We do it as what's called an inter alia mortgage that goes over both properties. But it gave them enough money, though, to outright buy the $700,000 home in Chilliwack but there's no payment to make. So it's rented out up and down for $3,000 a month, and that cash flow is all extra cash flow for these people. And that brings me to one other point is you don't have to let all the interest add up on this reverse mortgage. You can pay some of it. You can actually set up a regular payment, or once a year you can send us a check for up to 10% against your balance. So all that rental income, they can put it to use for other things, or if they want to put it back against this reverse mortgage, they can do that.
Wow, that's super powerful. And just like purchasing another home, there's so many use cases that would make sense to me. Like you think of somebody that's living in their, an empty nester, living free and clear, and always wanted that, that condo on the beach in Mexico or what have you. To be able to have that vacation home, something that they thought was never going to be possible, or they thought they were going to have to downsize or move to be able to, sell and take proceeds and go buy something else. Like that's a great reason too. Like, do you see people using funds to just purchase vacation homes just for that reason alone?
Yeah, 100%. One comes to mind that their dream was to have this Shuswap lakefront property to spend all these summers at with their kids and their grandkids and build all those memories. But all their money is sitting in their Vancouver property. It was worth like $3 million or something. So they, as long as they live in that home, that money just sits there relatively useless to them. They can't do anything with it. And we freed up almost $1 million for them. They bought a property at Shuswap. They got the boat, the furnishings, and they're enjoying all these summers there with their kids and building memories. And for them, they feel like they won the lottery. The money in the home was money that didn't feel real to them. It just was equity, and it was going to go to their kids one day. But man, how cool that they got to enjoy that.
Oh, totally. The last piece that comes to mind, and I haven't seen this yet, but we've seen a massive exodus of the millennial generation going to Alberta. So people leaving BC, going to Alberta to find cheaper homes, in a lot of cases making more money per hour. What comes to mind here is we have all these, young parents moving to these other provinces in our country, but their parents, the empty nesters, are sitting here at home and not getting to see, maybe their grandkids grow up, or, they're very, it's tough to go visit each other in this day and age. So one thing I was thinking that could be a great reason is like, you think of this, this old, let's say 70-year-old husband and wife living in Vancouver, and all their kids have now moved out to the, Alberta area and are growing their young families. A great idea would be to go buy a home that they could have there and go visit those kids regularly and be able to, something that they never thought of is like, hey, I got this free and clear home in Maple Ridge. Well, now I can go buy, a townhouse to visit my kids regularly in Alberta. And I could see that coming up quite a bit, because I can't believe how many clients in the last 2 years that we've worked with that have left and gone to Alberta. So I just wonder, is that something you're seeing, or would you agree that that's something that we could, would make a lot of sense going forward?
Yeah, it's absolutely a great idea, right? They can either, use the money to be flying back and forth all the time and paying for, all that expense, or they can buy a property that's going to go up over time. The other thing we see too is, maybe those kids don't want to move away. They're doing it out of necessity because they can't afford to live in the Lower Mainland anymore. And if this product allows the parent to early inherit money to the kids or pay off their mortgage for them, if that mortgage payment is gone, now the kids can afford to work at a lower paying job potentially, and they keep their kids and grandkids close by. So that can be pretty powerful. One other investment property one I want to mention that we're seeing a bit of too is because the market is a little bit slower right now, it's a great time to buy. And so we're seeing people that maybe want to buy their next home. They're eventually going to downsize, but they want to pick it up now instead of doing it, buying and selling in the same market. So an example comes to mind. We had people in this $1.6 million home, and they found $1 million condo, which is the place they eventually want to retire, but they're not ready to yet. They just want to own it now. And so we were able to do, $650 on their current home, $350 on the apartment, and that got them the $1 million they needed to buy that place without spending a dime of their own money. But now they own them both. They have no payments. They can rent one out for as many years as they want to, because rental rates are great, earn all that income. And when the time comes in the next good seller's market, they sell the house, transition into that apartment, and they made out pretty good.
Great point. Yeah, that's a good point.
Are there limitations if someone wanted to really go hard, and maybe like someone has a $2 million home and they can access $1 million of that? Do you guys have issues if that person wanted to really dig into the market, maybe buy 2 or 3 properties, maybe even 4, if all the numbers make sense? Or do you guys cap at 2 properties total?
Technically, we'll lend on up to 3 in total, as long as one of them is their primary residence. So yeah, we could essentially do a mortgage over a blanket mortgage over 3 properties.
Moving into the last point here, and to round out the episode, this one would hit home for me just because I've had family in in, care homes and whatnot. So maybe you can just explain the concept of, potentially being able to keep somebody at home and not having to go into a care home to kind of, end off their, their last years of their lives.
Yeah, and COVID brought that really to the forefront. Is a lot of people's desire to really age in place, and instead of having to transition to a care home. And so, what does that look like? Right? Is the home suitable for aging in place? Is it too many stairs? Do they need to sell and downsize to a rancher, or do they need to do some major renovations to their house? Or do they need to pay for a care worker to start coming in and start assisting with things as needs increase over time? And this can be a way to do all of those. So right sizing ends up being actually a very common one, where somebody says, look, my property is a little too big, too much yard work, too many stairs. I want to go find a nice rancher close to the amenities that I need. But oftentimes they can't afford that. Maybe they've sold their house, paid off all their debts, and they've got $600,000 left to go find that perfect forever home. But the place they really want is $1 million. How do they buy that place? Well, we can be used in a purchase transaction. So they can put down their 600. We give them a 400 reverse mortgage. They didn't have to qualify. They don't have to make payments, but they're in a home they're way happier in at $1 million than that, apartment or something at 600,000. So we're seeing that right sizing happening, but then we're also seeing our income advantage product being used for people to age in place. So they set it up on the home, take what they need to do, maybe the modifications, the chairlift, the bathtubs, that sort of thing, and then they draw the rest as a monthly income, and they can increase that monthly draw as their needs start to increase and they start to need more care.
That's such a good point. I mean, especially the in-home care piece. I think that most people don't really understand how excessive that cost can be until you're in the situation where you have to investigate it and you find out that it's $3,000 or $4,000 a month, and most people cannot afford to supplement that. Family can't even afford to supplement that, right? And so typically, if you can't afford it, your next step is like, okay, we have to put you into a home, right? Because it's not affordable, and that can just absolutely change, especially if it's someone's last few years on this earth. Like, why not do everything you can to be able to spend it at home with your family and in your long-term home.
Well, that's another good point about kids not being able to afford it either. A lot of the financial burden does end up falling on these adult children. They start to have to supplement the parents' income to pay for care, and they're spending time at the house doing maintenance on the home and that sort of thing. And so this is a really great way for the parents to be independent. They paid for that home. Now it's time for the home to pay for them.
Yeah, I mean, we made some really, really good points here. For me, it just looks like, one, it's definitely a financial planning tool. Like, that is what this is, in my opinion. And it's clear that these are definitely changing lives. Like, there's a huge rewarding factor to this whole, like, everything we just touched on. I can tell this is certainly changing people's lives for the better, and that's pretty rewarding. And I really thank you for coming on today. And any final words that you have to say?
You hit it on the head. It's I've been here 10.5 years. No plans on going anywhere. It's the most rewarding job I've done, because so many people don't really understand what it can do for them. And again, that's not to say it's for them, but for the people that it is for, it's life-changing, literally.
Awesome. Well, thank you, Chris.
Yeah. Okay. Thanks for having me.